All right, everyone. Welcome once again to the Exit Your Way Business Roundtable. Thanks for being here today. We are got a lot of fun to talk about. I think anyway, this is something we're very passionate about, and we help business clients work on a lot. Is really using the business valuation to help really create a valuable business, and that's what we're trying to do. I'm trying to do here today. I am working from one screen today, so if I seem a little bit like this and this, that's what I'm doing. I'm trying to navigate this thing. So Andrew, talk to me if the slides aren't changing right or something, because I'm actually have to get off this into PowerPoint as we get going. But first of all, like to welcome everyone. If you're on LinkedIn, go ahead and drop your comments in the live. We're going to be watching that. If you're here in Remo, go ahead and drop your comments there. Andrew will be pulling those things up. What we're going to do then is we are going to get rolling through this. We're probably going to finish about 8:40, 8:45. We'll spend some time talking at the tables after that, and we'll be wrapped up by 9 o'clock. So, Andrew, a subject that we talk about a lot.
Yeah, I mean, it's really, this is the core to Exit Your Way, and the core to the business owner and or any entrepreneur, I think, is understanding valuation and knowing where you're at. And it's a little art and science, but, combination of both. And I think it's, and we love talking about it because it's also one of the most overlooked things that we come across in business. As entrepreneurs are looking at everything else, and then the last thing they think about is their business value.
Yeah.
I think we're on a mission to maybe change that.
Exactly. That's awesome, because that's really what we are. We're on a mission to help business owners really either change their thinking a little bit or add this to their thinking a little bit, because what we see and what every person that helps a business owner at the end either sell or succeed their business is disappointment in the value, disappointment in they can't sell, and other things like that. And if you look at these things early, you really can make a difference to your business and your exit, whether you're succeeding to family or something like that, or selling your business. So I'm going to get started on the presentation here, Andrew, and if the slides changed, let me know. So
sure.
Did they go ahead and update there? Did it change?
Yeah.
Okay. Yep. Awesome.
Well, Damon is, he didn't tell you guys, but he's a Portify artist, so that's why he's not in his studio. That's why he's on one screen, and that's a fake background because he's actually sitting on the beach.
Yeah. Yeah. Well, it is something that virtual work has allowed us to do, is to really explore our opportunities. And as business owners, I think we need to do that to keep our sanity and our drive. So yes, I am. It is a little warmer than I'm used to in Seattle, but we're dealing with that. So when we look
I'm not jealous, it's okay.
What's that?
So, I'm not jealous, it's okay.
Yeah, you've got a foot of snow, so
yeah, that's true.
It's going to be good skiing. So when we look at there's some key business valuation information that you get. And really what I wanted to do in this first part of it is really identify some of those things and go through, all right, what are some of the key factors that we really should look at? Because I'm going to tell you, this is where most people stop when they look at their valuation. You agree, Andrew?
Yep, absolutely.
They go, my business is worth this. And then they think that this is the fixed number, that if somebody tells them it's worth $10 million, it's worth $10 million. I should be able to get $10 million.
Yeah.
There's a lot more to it than that. Right, Andrew?
Yeah, it certainly is. And I think too, it is not a static, valuation is one thing to really understand is it changes daily. And we know this, we all know this, and we should know this, but when they have this idea about a number or a multiple that they're looking for, this is one of the, if you don't really understand how that value moves, from day to day. Like I said, we do know this because just look at the stock market. Those are businesses too. A lot more information in there about those businesses. But, every day, that's why we report, you can go into the paper or go on the internet and Google your stock that you own, and you can see what it's worth today and what it's worth trading at tomorrow. But they have a much better system for it than the small business owner does.
Yeah.
So, but that one of the, this is probably the most valuable information that you need to know. And it's in order to make the right business decisions, right? Knowing where you're at, and then you can determine where you want to be.
Yeah. So the number, it obviously, as you said, Andrew, it is very important understanding your number and where you're at today, because as we go through this, you'll be able to see some of the things and why knowing your number is important. But also we're going to show some of the other things that you really need to consider. And this is the next thing that happens, and really the current value multiple of your business. There's going to be different things, that different multiples. And talk about these again real quick, Andrew, the multiples, revenue multiples of EBITDA, multiples of cash flow, those kind of things that you're going to see.
Mm-hmm. Multiples, it's just an indicator that the market uses really to determine a value. It's really, used a lot by private equity groups. And it's, to me, there's various, rules of thumb on multiples, but you can, this is real data. You can take this anyways, and you can really see where the market is. It's hard to get that data, but you can look at transactions, and then, these are companies, what size companies were they, what kind of revenue are they generating, what kind of cash flow are they doing, what industry are they in, are all factors on those multiples. But you will see size premium. That's what we feel, bigger companies, are more attractive, considered more stable, and therefore, they drive higher multiples.
Yeah.
And I think that we're seeing here in this scale. But, for example, a small owner operated business, under $1 million in revenue, where the owner works in the business, is going to be in that lower range, in a 4x, 3 to 4x range. And you can prove this because if you look at transactions for companies in that size or businesses, say restaurants or, as a good example, that's where they trade, because we actually look at actual transactions.
Yeah.
So that you can really kind of get a determination of where that market affects that multiple or number. And then, but there are other factors about that too that you have to consider. So that can change those things.
Yeah. Yeah. And in your business valuation, though, you're going to see that there's different multiples that the person doing the valuation has established for your business based on your industry and everything else, and consider this and look at those in your valuation. The multiple, I just put an image in there, multiples times 4. It doesn't mean anything in the value of a business, but you understanding your current value multiples of EBITDA, of revenue, of cash flow, whatever those are, is important as you go forward. And then talk about the multiple range, Andrew, because this is something that we use a lot when we're working with clients to really understand what it would do, what we could do if they could grow the business.
Yeah, for sure. We can always go in, using valuation techniques, and this is, for us, it's critical path, because the first question we get asked by a client, when they come in and say, I need your help selling the business, the first question they're going to ask is, I'm not sure what's it worth. So we have to do that. And the multiple range is a good way. We know, as we've had a fair bit of experience and we've seen a lot of deals and actual transactions, because at the end of the day, that is the real decider, is whoever writes that check. That's the determination of the value. But getting in that range is important. So if you're between a 3 and a 4x, you can get a pretty good idea where you are in that range. And then you can look at factors saying, well, other companies in your industry are trading at a 5 or 6x. Well, what's different about them to get that kind of multiple?
Yeah.
And then we start looking at those factors in the business, and it's, And there's a lot of them. And the factors that we look at that can help you get out of that range. Well, a common one is growth or size, and, if you can, if you're a $10 million business with, this is very broad, the thing with a $2 million in cash flow, which is a good 20% return, annual return, you can probably looking at a 4 to 5x multiple, this is an example, but if we can get to 25 million in revenue on a 4, your size premium comes into effect and you might get a 6 or 7 multiple.
Yeah.
That's just, again. So you've got to really look at that too. And there's,
and we've got some examples here in the end that we're going to later on that we're going to look at, but really understanding the multiple range for your industry, because they should be giving you some data on this, and look at the median. And we've shown that before. We're going to show it again on an example of where your range is on multiples, because in your industry, you should be able to say, okay, at the low end, my multiple might be a 1x, or in my high end, it might be a 10x or whatever, and see where you fit in that range to really understand. Mark has a question. How does predictability play into the multiple calculation? That's a good one, because it does.
Yeah, absolutely. Yeah, very, very good question. That's, recurring revenue.
Yeah.
That's the most important thing. And, you have to, so if you're doing actual valuations, we're going to look back at least 5 years. So, sometimes we can do it with 3 years, but 5 years of your historical data, and you've got to show that predictability there, and that supports that. So value goes up and down depending on how stable that is. And also value can go up too if there's a growth trend that looks sustainable and repeatable.
Yeah.
And those are factors that we. There's mathematical things you can do to discount those, and understand mathematically how the numbers work that will discount that predictability if it is predictable. And then there are others, which is really just understanding the customers, the market, stability, outside factors like that as well. Management, experience.
We'll go through some of those as well. But, when we talk about this, the current, we always stop at the number, then we should dig into the current value multiples, and then the multiple range. We understand that. And then
go back to the multiple thing again too. And I do want to reemphasize, this kind of scale is only for small privately held businesses, small and medium-sized businesses. This is not publicly traded companies. And it gives somebody an idea about what that is. Currently, of our GDP, 51% of our GDP comes from, a majority of it comes from small, medium businesses, the lower middle market, whereas 49% is then the big publicly traded companies, and their multiples are way higher than these. That's why everybody wants to go public.
And it does. And as we go through the multiple range, we talk about another key piece of business information, or business valuation information that's often overlooked, are the industry benchmarks and how your company compares to industry benchmarks. So, Andrew, how does this really affect your valuation, and how can you use this to improve your value over time?
This is great information too, and because the information that you get on actual transactions happening is very difficult to attain, and the benchmarking data is something you can get fairly readily, mostly because of the banks. The lenders are compiling this kind of data constantly, and they use it as a risk management tool. Whether they give a loan to a person, whether they understand some of their, if their assets are in trouble, they look at benchmarks and you can identify that. And on the other hand, you can also use benchmarking to see kind of where you land within your peers. And see where you're out of line, or where they're in, you can use it to identify opportunities to improve your processes too. And some of them are not things you can fix necessarily. So,
yeah. And we're going to talk about that later and show an example. And this is what we're going through are these things. And then we're going to show examples of how we've helped clients or how you can use it in your business to really start measuring some of these things. And then ultimately, the other piece that I think is really overlooked in the valuation are the business risks that you identify as you go through the valuation process. So, Andrew, when you look at that and we're talking about business risks, what are some of the things that you really think that people overlook in this part of the business valuation?
Yeah, I mean, business risk is everything. And I think that a business owner maybe overlooks this a lot. They're not thinking about that too. So they have to put your empathy hat here and really understand what it's like on the other side of the table, where the buyer's coming in to buy the business and is looking at all the risk factors and whether that all adds up to whether this is a go or a no-go, and also translates back into, what am I willing to pay for this?
Yeah.
But risk, business owners don't necessarily think about risk because they've took the risk. They've been doing it for so long. They took the risk from day one, so it's there. It's been in the room. It's not like the elephant in the room. They've got all their assets tied up into their business. They've been doing it for 20 years. They borrowed money from friends and family to build it up. They've paid that off. They got competitors coming in all the time. All these things that for them, it's just standard operating.
It's just doing business. You're right. And when you look at the business risk, there's really the customer risk, that concentration we've talked about before, the product or service risk. Are you a one-trick pony? And I always like this, Tickle Me Elmo. I remember that came out, it was the biggest thing ever because my kids were small, and it shows the age of my kids too. But, if you only have one product and that product goes out of favor, your business kind of goes to heck. Or you have one service, and these are things that people overlook because the valuation might say that your business is worth $10 million. But if you have one customer that's giving you $10 million or one product that's giving you that $10 million, it's much different risk profile than something that's diversified and has predictable revenue, as Mark says.
Yeah, especially and this is a real situation, that we deal with all the time is the customer too is also 75 years old and they're golf partners.
Yeah.
With this customer, and they're both retiring.
Yeah. That's a great customer risk that actually we're going to talk about in a minute when we start to look at how do we track and improve these things. But that I can't tell you, how many times we run into that, Andrew, because you've got someone that's been very successful in business and doing business with other people in their age group, and the buyer comes in or someone comes in and looks at, they're going to give this business to your kid, they're going to try it to someone else, and they look at all the customers, they go, every one of your relationships are going to be gone in the next 5 years. Mm-hmm. And that's a big deal to them. So it's, your customer risk, your relationship, and all these things play in. And then when we look at this, again, the same thing in your management team. Do you have a vibrant team? Do you have a team that's going to be there well beyond the transition?
This is legacy.
Yeah.
This is what people talk about. If you've built a legacy, not because you want to do that because you're altruistic or everything else, but if you want to sell a business, I mean, it's obviously attractive that a company can run, you've built something that can run, anybody can plug and play. This is the turnkey term that everybody floats out there. It's a truly turnkey. Yeah. This is your asset, your management team, the people who do all the work for you, your integrators, your leadership teams, and this is the second, the first thing they're going to look at financials. And, a buyer's going to come in and does it make sense financially, mathematically? And then the next step is, let's look at the people.
Yeah. They're going to see, yeah, exactly. You're going to look at the profitability, then it's going to be the customers and the team and suppliers and other things like that. And that's why we're spending time on the risk, because the these risks, even the industry risks, when I look at the industries, I mean, us, being in the Northwest, being around aerospace like we are, man, if you were tied up 100% into commercial aerospace in the end of 2019 and you hit 2020, there's some serious industry risks. The oil and gas industry coming in that same time frame. Industry risk. If you're all concentrated into one industry, it's very detrimental to your business valuation and the long-term legacy of your business.
Yeah, and one of the things is why, in this case too, because all this really does though doesn't make your company have no value. No, not necessarily. I mean, lots of people are making lots and lots of money in the auto industry, which goes up and down, or in the oil, the gas, which goes really up and down.
Yep.
But as a buyer, there's a risk factor there you have to analyze. So you have to have resources to be able to survive the going down. So you have to bring that going in, which of course in turn lowers your value necessarily.
Yep.
And that's not a bad thing. It just means this is where you're at.
Yeah.
And I need to understand that.
And you make a good point, Andrew. There are deals done every day in volatile industries. And it's just how good can you be relative to your industry? How good can you survive the downturns? And if you can prove that over time, any of these risks can be mitigated if you show the performance through the bad times. So as we're going forward here, now that you've got this information, you've got a valuation, and how can you really transfer this information or this knowledge into value? And this is where I think it becomes fun, because we just, what we were doing here is just covering what many people know, their risk in business. But when we look, and why we talk about risk so much, because it can kill your exit, selling or succeeding. If there's too much risk, as Andrew said, you've been able to build and mitigate the risk to yourself as an owner over years and years and years. The buyer has to come in and assume all that risk. And this is often where deals are killed. Correct, Andrew?
Well, yeah. And not only that, again, this has got to put the empathy hat in. Feel, what is it like to be the buyer on this side? You've already built equity in the business, even though a lot of business owners don't necessarily know that. They know it cash flows, they know it earns money, but they actually have built equity here. But the buyers are coming in levering themselves out. So that's risk. They're taking on a huge amount of risk, and they're not the only ones involved in the purchase, the lenders. And we know that lenders are very risk averse.
Yeah. Yep.
And they're very good at identifying risks. And
yeah.
And so, and getting them to go on a deal is a difficult task.
You bet.
Because, you're starting less than zero, and you got to, within a reasonable amount of time, you've got to continue the business, grow it enough, enhance it to pay down that debt service and build equity.
Yeah. Yeah. So how do you really use this information? So you're going to identify these risks in the business valuation step. They're going to talk about these. If you're using a good valuation source, there's lots of sources, but using a good valuation source, they're going to talk about these risks. They're going to talk about your customer diversity, industry risks. This is all going to be detailed out a bit in your valuation. So really it comes down to understanding, tracking where you're at with these things, and improving these risks. So when you look at customer diversity, Andrew, that to me always comes up because it is almost the second question after when people start diligence is, where do your sales come from?
Yeah.
And
yeah, I think that's number 3 on the list. You start with, they look at the numbers, they look at the people, they want to talk to the management first, and the next one is what's your customers look like? You bet. Where are we in the market? Yeah. Diversity is important, and this is, one of the things that, you can change. If you understand your number, you understand how that affects value. you can jump in there and you can add new clients. You can vertically integrate and get a new product line. These are things that you should be doing anyways. If you understand you're trying to build a legacy type business.
Yeah. So if you look at customer diversity and you're tracking this, a simple way to track it is just to go, okay, what's my biggest customer and how much of my total revenue do they have? And that's a simple to do. Now, Andrew, what is a reasonable number for people to look at when you look at that? Is it, 30%, 50%, 70%, for your biggest customer? What really do you think is?
What they're going to look at is the buyer is going to look at, or evaluator is going to look at, list of your customers and what percentage of your sales are attributable to that customer in the last year. So if they're looking at recent, because this is not over a 10-year period of 5-year period. It's really about what's happening in the past year. And if you have one client that's 40% of your revenue, the question is, this is how you determine where your risk is. What if you lose that customer tomorrow? You got a 40% drop. Do you even survive? And especially if you just borrowed, you're on the hook for $10 million that you borrowed to buy this business.
Yeah, that's a great point. And Magid just had a question about that. How important is it not to have majority of your revenue coming from a large client or two? And you just explained what it is from the perspective of somebody coming in and I'm borrowing a bunch of money and I'm investing a bunch of my own money into a business when I buy it. They really want to see what it's like if one or more of those go away, and see that your business is going to be able to survive, because it can, as when we were talking to Thomas Campbell on buying businesses a few episodes ago, he really explained it well. He said, it can ruin my life.
Yeah, it certainly can. And I think the way to understand it and identify it is what impact will it have on your cash flow if you lost customer number one, number two. If you lost customer number one and it's more than 10% of your revenue, can you survive that? Now, and not only that, then think about, could I survive it, or could the person who's buying my company survive it? So understanding it is you could probably, it's a body blow. You lost that customer, but you already have enough equity in the company. You got access to credit to ride it out. You may lose for a few more months, and you'll be putting resources into replacing that customer very quickly. What you should be doing is not waiting till that happens to go and get, a more diverse customer base. If you see that's going to, if I lose that customer, I need to be working hard to make him less of my revenue stream.
Yeah. And it's a great point that you brought up there, Andrew. And I'm just going to get a little more detail into this really quickly. The existing owner today can survive that customer going away because they're not paying the debt payments on the loan for buying that business. So as you said in there, and you said it quickly, but this is really key. You have to be able to, as the new owner of the business, survive losing that major customer. And that includes an additional debt payment that you're probably not doing right now.
Yeah, you don't think about that, right? Those are the hurdles that the new buyer, you do need to think about that, because that's part of your evaluation when you look at customer diversity.
Yep. And Pete,
at the end of the day too, I mean, this trickles down and more into valuation too, because if you're too dense in your customer spread, then the banks aren't going to lend you money.
Yep.
That leaves you only be able to sell your business as a cash buyer, which limits your market and lowers your value.
Yeah. This is one of the biggest ones, and Pete talked about it here in the comments too. He said it's something they learned in their business that was so important. No single customer makes up 10% of the company's revenue now, and it's right, because a lot of companies have. Some have 70, 80%, and that's fine. As you said, Andrew, you could survive that maybe as the current owner, but when you're paying a loan off as a buyer of a business or the next generation of the business, it could kill it.
Yeah, and there's exceptions.
Yeah.
You know, especially in aerospace, or if you're a supplier to a big
Yep.
industry like that, which is those conglomerates, or you're a contractor for military or government contractor. Government's the best customer in the world.
Yeah,
They're
yeah.
a tough customer, but the banks understand. Okay, that's fine. 90% of my clients is to the DoD sales, but because they don't have high margin, but they get paid. They're good customers, and they don't generally remove their supply base. So
Yeah.
So the risk is a little less there, but man, those companies too, and I've worked with them directly, and Damon and I both have, especially in aerospace, where we were specifically working with these companies to help them diversify away from Boeing work or those big primes, and it's a very difficult thing to do.
Yeah. Yep. And Pete's got he's looking at an acquisition right now where a competitor's got 66% of their business with one customer. And yeah, you're not going to be able to pay much of a multiple for that. Or sometimes even we've seen, and we go in as that part of the business is carved out from the rest of the business, and that's paid more on how much of that business remains over time. And the value is tied to that. There's lots of different ways, but it sure hamstrings the person trying to sell or succeed the business if that customer diversity is not there.
Yeah.
So I'm going to run through these other things quick, because each one of these things, just like the customer diversity, come up with a measure in your business for it. Understand that and understand how you're improving these. Just the same thing with products and services. Diversify revenue from products and services or channels of sales as much as you can. And looking at your management team, really understand, is that management team ready for the next 10 years? And are they doing the appropriate things? But come up with the measures really to understand, am I making the changes to make these risks go better? Because in the end, as you improve these risks, you improve the sellability of your company and the value of your company overall.
Yeah. Well, I think one of the things too is you can increase your value just by acknowledging that you have a problem.
Yep.
Right. So if you do have a customer diversity problem, that's fine. That's what it is. But the other thing is to have a strategy behind that to mitigate that risk. And if you can you present that to a valuation or to a buyer, and for example, this is a pretty simple fix. We just need to add 2 more clients, and that customer mix will flatten out. And here's our sales team. Here's our sales strategy. All that's got to be on paper. It's processed, and there's people working on it. And these are our people who are good and experienced at doing this. You can pull even without eliminating the diversity problem, customer diversity problem. You could probably get a buyer to go, that's acceptable, because I could see they know they have a problem and they're working on it. And I believe in the team that's in the strategy, they're going to get it done.
Yeah.
So,
yep.
Even that little step will help.
So again,
there's nothing better than just adding a couple customers.
Yeah. Yeah. And again, these risks can kill your exit, and you gotta be able to mitigate them and show that you understand them and you're working on them for that to make that successful.
And I think one of the things is maybe this sounds hard, but in my experience is when I go into companies like this too, where everybody's looking for what's happened most currently in the last 12 months. This is really important to understand. And so if you get to work on that now and you want to sell your business in the next couple of years, you can, if you can accomplish some of these goals on the strategy, you're going to help your value a lot. I mean, it can really jump up and help the business get sold.
Yeah. Yeah. That's sweet here.
But I think I worked with a company before. It was about the 3 or 4 million range right after 9/11 happened, and the owner doubled down in a recession, and he was smart about it. He's putting money into sales and marketing and grew that company up. And one of the things I learned from that experience was, that size company, it doesn't really take that much. It's just elbow grease.
Yeah.
Really go in Because if we really put our mind to it, we can have a big effect because we're not that big a company.
Yeah.
We can go to 3 to 10 million with a couple different customers, and he was at 10 to 15 million in top line revenue in a matter of 15 months.
Yeah.
That's what you can do. It's harder to do that in a big company, but
yeah. And that's why, honestly, that the majority of the privately owned companies are this is very much in their control and their ability to do this. And so when we look at the other factors in this, and we've talked plenty about risk, and you need to understand them, you need to be mitigating, but when it comes down to really tracking and improving value, there's one thing that I think that you got the valuation, and using this valuation information, one of the things that we really discovered is add the enterprise value line to your financials. If you start to do this, and this is just an excerpt from one of the client things that we've worked with before, is you look at, this is a rolling 12-month adjusted, and people want to talk about details on this, but this is a given month, and you get the multiple that you've got on EBITDA from your valuation, and you go, okay, my rolling 12 months is X. Now this is I get my multiple from my valuation. This is my approximate enterprise value. So Andrew, how does this really help to focus people and keep the attention on the terminal exit of the business?
Yeah, and I think this is one of the first things we put in place when we start working with a client. And again, this is a monthly measure.
Yeah.
Right? Every month you're looking at what did I do for the last 12 months? And the reason we do this is how did we perform over, this 12-month period? Because this is what the buyers look at. And this value, if you start tracking it, you're going to be surprised how much it changes up and down over time. And you really want to see what that trend is, right? Because the buyers are going to come in and go, I'm looking at your trailing 12-month EBITDA. Oh, okay. Why are they looking at that? I've been making, $1 million in EBITDA for 10 years in a row. They don't care about what you did 10 years in a row. It's what have you done for me lately? And this is the central part of our talk and negotiation when we start dealing with getting an actual offer on a business, is that 12-month period, and good or bad. And, it takes time to sell a business, so you're talking, 4, 5, 6 months with diligence and everything that needs to be done. And your EBITDA can drop. You're rolling 12-month EBITDA from one month to another. If it drops, deal's dead.
Yeah. And that's really, really a great point there, Andrew. And this is where you want to start doing this early and get used to it, and get get used to making sure that value continues to inch its way upward as aggressively as possible. And Mark's got a good question. He said, what's a seller going to probe to determine if an upward trajectory in sales or EBITDA in the past 12 months is sustainable or repeatable? It's an awesome question, Mark. And this is going to be one of the future things that we're going to go over, because when you go from the history, you go forward, and we really have to look. And this is where Andrew gets really excited, and I do too, because if we've taken the time to lay out an annual budget and where we're going to get to those sales, not just put numbers on a piece of paper, but go to the level of our sales are going to increase in this product or this service in this channel, and then we're tracking that throughout the periods as we go forward. What we've given is we've laid the foundation in historical data showing that we said we're going to sell $1 million to this place, and we have. And then you turn around and you go, okay, we've shown that we're going to do what we said in the past, and this is where we're going in the future. And then Andrew, how does that help in the sale of a business when you have that information, as Mark's saying?
Yeah. And I think, one of the things that, we say in this business is, the forward, you look forward and you say, that's potential. We're going to, we're sitting at 6 million in trailing 12-month revenue right now. And by the year end, we're going to be at 10 million. buyers will buy a business for potential, but they don't pay for it. However, if you can flip that paradigm. Buyers are going to value the business today, where it's valued today, and try to lock in that number. Mm-hmm. And like I said, as time goes on, that can go up or down. But if you have a well-written strategy and have people behind it that is supported by the historical data going forward, and you're actually tracking it monthly performance, basically you're proving it out.
Yeah.
And if a buyer sees that growth trend, your strategy that's locked and disciplined,
being proven,
are delivering on it, then we can start to say value is in the projections, not in what you did today. And that's the key. And then your multiple then, where it was a 3 to 4x could become a 6 to 7x. This is a quantum jump. This is adding zeros.
Yeah.
As my friend Brad Smith likes to say.
Yeah. So Pete,
and that's a short period of time. That's within months.
Yeah, it is. It is. And Pete's got another good question. Are we finding that COVID-related revenue drops is reasonable for potential buyers, especially if the company is showing a rebound? And I think, we have a couple clients that had severe COVID rebounds, or drops and then rebounds, because they had basically had to shut things down and start again. And correct me if I'm wrong, Andrew, but buyers and everybody else has looked at those like a blip, like a one-time thing, and we don't consider it. And
it depends. There are factors, and COVID is an event that happened, but you'll notice on here we call rolling 12 months adjusted.
Yeah.
The adjusted part is, we have, and there's two things that happen. You either had a good year through COVID or you had a bad year.
Yeah.
And the only question on it is we adjust that out, and we go with more about what our performance was on that EBITDA over the last few years. So we may adjust out the negative impacts that COVID had on your business because we consider it an anomaly. Okay. However, you just have to be able to prove that.
Yeah. Yeah.
Is it really an anomaly? Is your balance still strong enough to suggest it? Is things going to get back to normal?
Yeah.
And the evaluator will determine that, right? So if they feel like, this company, and you look at the projections, and
yep,
you see where you're going to be, but not a big impact on today's valuation. Again, like I said, moving target.
Yeah. And one more thing that we do often is, as we're working with clients, add those industry benchmarks to your financials, because knowing where you're at compared to the industry really helps too. It helps to substantiate value. It also makes you, when you're looking at the medians and where values tend, if you're using the right industry benchmarks, it can help you demand a higher value than the average for your business. The last but not least, and we're going to run through this one fairly quickly, is there are value curves, right? There's value curves like with everything. And as your profitability goes up, as you move to the right, your value multiple goes up. And there's where the steep part of the curve is typically where, if you can get into that steep part of the curve, as you go left to right, from that first red line to the right a little bit, the value multiple can change a lot. And this is where you get what Andrew talked about, is the double effect of that is my profitability goes up, but also my multiple might go from 3x my total profitability to 4x my total profitability, or 5 or 6 in a very short amount of profitability increase. And that's where knowing where you're at and where your value multiple is at is key in really planning your exit, because you don't want to be up here past the second red line, because the buyer of your business is not going to be able to realize that as well. They want some of this value increase. So get yourself up this a ways, but leave them plenty of room as well.
Yeah, and this is the beauty of being in a small, medium, lower middle market business, because this curve does shoot up like that, and you can do something about it. This is not impossible.
Yeah.
To have that kind of effect. The other thing to think about too is we're talking a lot about this, about organic growth, And the other thing is, there are, just because you're a small business doesn't mean you can't operate it like it's a big business.
Yeah.
And learn from what the big boys do. But growth through acquisition isn't probably something that, a $10 million business, a top line with 20 employees is thinking about. But, a smart owner can pick up maybe an ailing competitor, or, somebody who's in a synergistic business, and actually, if you understand that and the financial side of it, paying for that and just being able to cover the debt service.
Yeah.
Adding that revenue line to your top, diversifying your customer base, eliminating all those risks, cherry picking some of their management team. You could have a major impact on that curve.
Yeah. Yep.
At that point, and you can do that relatively quickly, within less than a year.
Mm-hmm. And I'm going to wrap up with this is an example that we've shown before. If you look at the median, it's 3-point-something X on the EBITDA, up to 10.3X. And it starts from something that's $1 million in revenue up to 16 million in revenue. So, someone in here that can go, say they combine some companies and get this thing into a $8 to $10 million revenue, they could potentially go from 3 to 5X into the 7 to 8X, where, you're talking 2-3 multiples of profitability on that revenue. And if that's a few $1 million, that's a significant increase in your overall value without adding any additional profitability. And I mean, growing sales, it's really, as you're talking about, combining companies together to increase the value just gives you that multiple bump.
Yeah. You can see here too. This is a table with actual transactions.
Yes.
So to let people know that's 9 transactions. That's 9 companies got sold on those sales dates between that time period. That's the size of the company, and you can see that there's quartiles up for the 10th percentile up through the 90th percentile, and watching how those multiples move into those percentiles. Again, we talked about that. That's actual real data. To me, the realest baseline for valuation is right there, because this is actual money changing hands for businesses.
Yep. So wrapping up, that was the last slide in the presentation. So we did this pretty well. It took us a couple minutes longer than we wanted, but thanks so much for being here, everyone. We appreciate your time. We're going to drop off the live broadcast. We're going to go back to the StreamYard. I want to just say, JD, thanks for the question. I will get back to that question on to you individually on that on LinkedIn Live there. And we're going to go back to Remo here for a moment and say goodbye to everyone and go from there. So thanks so much.